You've heard of 2008. You've heard of 1929. But there's a crash worse than both, and almost nobody remembers it. It started with a single, greedy scheme to corner a copper market. Within weeks, it nearly destroyed the entire American economy. No FDIC. No Federal Reserve. No safety net of any kind. Just one man's fortune standing between order and total collapse. This is the story of the panic of 1907. The crash that quietly rewrote the rules of modern banking forever. By the time it ended, trust companies had failed, the stock market had cratered, and ordinary families lost everything overnight. And yet today, most people couldn't tell you a single name connected to it. That's about to change. Because understanding 1907 means understanding why the Federal Reserve exists at all, and why it almost didn't. Stick around, because the parallels to today's financial system are honestly unsettling. Let's go back to 1907. New York City, the richest, most powerful financial center on Earth, built on a system with one fatal flaw. There was no central bank to step in when things went wrong. No one was coming to help. America in 1907 was riding an industrial boom. Railroads, steel, and Wall Street speculation were reshaping the entire country. But underneath the optimism, the banking system was fragile, a patchwork of competing banks with almost no real oversight. Trust companies had quietly become the most dangerous players of all. They held deposits like banks, but followed none of the rules. They could lend more aggressively, take bigger risks, and answer to almost no regulator. It was a system built on confidence alone. And confidence, as history keeps proving, is the most fragile currency of all. All it takes is one crack. That crack was about to come from an unlikely place. A scheme to manipulate the price of copper. Two brothers, Augustus and Otto Heinze, believed they could corner the market on United Copper Company stock. Their plan was simple on paper. Buy enough shares that short sellers would be forced to pay any price to cover. If it worked, they'd make a fortune. If it failed, it would set off a chain reaction no one could stop. Spoiler, it failed. Spectacularly. And the fallout was about to spread far beyond a single copper company. In October 1907, the Heinze brothers made their move, buying up shares of United Copper at an aggressive pace. But the short sellers didn't panic the way they expected. Instead, more shares appeared from sources the brothers hadn't accounted for. The corner collapsed almost instantly. United Copper's stock price crashed from over $60 to under $10 in days. That alone should have stayed a small, contained disaster. Except the Heinze family controlled something far more dangerous than copper. Augustus Heinze sat on the board of several banks and trust companies, including the Mercantile National Bank. Depositors panicked. If Heinze's copper scheme failed this badly, what else might be unstable behind closed doors? Within days, a wave of suspicion swept across New York's financial institutions, and depositors began pulling money out everywhere. Bank runs aren't rational in the moment they happen. They're emotional, contagious, and brutally fast. At the time, Knickerbocker was the third largest trust company in New York City. Its collapse would change everything. Knickerbocker's president, Charles Barney, had loose financial ties to the Heinze circle, enough to spook the public. On October 22, 1907, depositors lined up outside Knickerbocker Trust, desperate to withdraw their savings before it was too late. In just 3 hours, the trust paid out over $8 million. Then it simply ran out of cash. Knickerbocker Trust collapsed completely, and the panic it triggered spread like wildfire to other trust companies across the city. Trust Company of America was next, facing the exact same desperate run from terrified depositors demanding their money back. Remember, none of these institutions had deposit insurance. If your bank failed, your money simply vanished with it. Imagine the fear. Lifetime savings gone in an afternoon, with absolutely no government program to make you whole again. This wasn't an abstract financial event. It was families losing their homes, their businesses, and their futures within days. And the panic hadn't even reached its worst point yet. The stock market was about to feel the shockwaves too. Because when trust companies stop lending, the entire economy starts to seize up, and Wall Street felt it immediately. By October 24th, the New York Stock Exchange was in freefall, as panicked trust companies called in loans across the board. Brokers couldn't get the short-term credit they needed to keep trading. Without that credit, the entire exchange risked shutting down. Some historians argue the percentage decline in 1907 was actually steeper, in some measures, than the crash of 1929. The New York Stock Exchange came within hours of closing entirely, something that hadn't happened since the Civil War. If the exchange had shut its doors, the panic could have cascaded into a full collapse of the global financial system. There was no Federal Reserve to inject emergency liquidity, no central authority with the power or the cash to intervene. So one man stepped into that vacuum, a man whose personal fortune was about to become America's financial safety net. His name was John Pierpont Morgan, and what he did next would single-handedly determine the fate of the entire economy. At 70 years old, Morgan gathered the country's most powerful bankers into his private library on Madison Avenue. What happened inside that room over the following days has become one of the most remarkable stories in financial history. Morgan personally reviewed the books of failing trust companies, deciding in real time which institutions deserved to be saved. He pledged his own money first, then pressured other wealthy bankers to match his contributions to a rescue fund. At one point, Morgan literally locked bank presidents inside his library until they agreed to commit emergency funds. It sounds almost unbelievable today. One private citizen, deciding the fate of the entire American financial system overnight. But it worked. Morgan's coordinated rescue fund stabilized the trust companies and prevented the New York Stock Exchange from closing. He even convinced New York City's mayor to delay a separate funding crisis, buying the system precious extra time. Within roughly 2 weeks, the most acute phase of the panic had passed, largely because of one man's intervention. Imagine that for a second. The entire fate of the U.S. economy resting on the judgment of a single banker. It worked this time. But everyone in that room knew the country couldn't keep depending on private luck forever. The panic of 1907 had exposed a terrifying truth. America's financial system had no real safety net at all. Beyond Morgan, a handful of other figures shaped how the crisis unfolded. Some heroic, some deeply self-interested. George Cortelyou, the U.S. Treasury Secretary, deposited federal funds into struggling banks, an early and unusual form of government support. James Stillman of National City Bank worked closely with Morgan, helping coordinate the flow of emergency rescue funds. Even a young, ambitious financier named Benjamin Strong played a key role. And his story doesn't end with 1907. Strong's experience navigating the crisis would directly shape his future role as the first head of the New York Federal Reserve. Meanwhile, the men whose recklessness sparked it all, the Heinze brothers, faced a far less heroic outcome. Augustus Heinze was later indicted, though largely escaped the most severe penalties given his connections and resources. Charles Barney, the Knickerbocker Trust president whose institution triggered the deepest panic, took his own life soon after. The human cost of 1907 wasn't abstract. It included ruined careers, lost fortunes, and at least one tragic death. And yet, despite all of this drama, 1907 rarely appears in mainstream conversations about financial history today. Why? Part of the answer is timing. 1907 happened before mass media, before television, before the 24-hour news cycle existed. There were no viral images of crowds outside banks, no footage circulating for generations the way Great Depression photos did. It also happened before the creation of federal deposit insurance, so the public never connected it to today's protections. 1929 became the cultural reference point for economic disaster, eclipsing earlier panics in the collective American memory entirely. By the time 2008 arrived, journalists and economists reached for 1929 as the comparison, not the more obscure 1907. There's also a textbook problem. 1907 doesn't fit neatly into standard curricula the way the Depression or 2008 do. It's wedged into a single paragraph in most economics courses, usually just before a section on the Federal Reserve's founding. Ironically, that brief mention undersells just how close the entire system came to a complete and total collapse. This is a crisis that arguably saved itself only through one billionaire's personal intervention. And we barely talk about it. But its consequences reshaped the architecture of American finance more permanently than almost any other event in history. Look closely, and 1907's fingerprints are all over modern financial crises, especially the one we lived through in 2008. Trust companies in 1907 behaved almost exactly like the shadow banks that triggered chaos a century later. Both crises involved lightly regulated institutions taking on risks that traditional, heavily supervised banks weren't legally allowed to take. Both crises spread through contagion and panic faster than any individual institution's actual underlying financial health justified. And in both cases, a small number of decision-makers behind closed doors determined which institutions would survive and which wouldn't. In 2008, it was the Treasury Department and Federal Reserve making those calls. In 1907, it was one private banker. That difference is exactly why the Federal Reserve exists today, so that decision never again rests in just one man's hands. Moral hazard is another eerie parallel. Both crises raise the uncomfortable question of who gets bailed out, and why. Even the too big to fail debate of 2008 has roots in 1907, when some institutions were simply too connected to collapse. History doesn't repeat exactly, but in finance, it rhymes loudly enough that the echoes are impossible to ignore. The most lasting consequence of 1907 wasn't financial at all. It was institutional. It changed how America governs money. Congress created the National Monetary Commission in 1908, tasked with studying exactly why the panic had spiraled out of control. Senator Nelson Aldrich led secret meetings, famously held on Jekyll Island, to design a new centralized banking system. Those meetings directly led to the creation of the Federal Reserve System, signed into law by President Wilson in 1913. For the first time, America had a central authority designed specifically to prevent the kind of panic 1907 had unleashed. Every emergency rate cut, every modern bailout, every lender of last resort, policy traces directly back to this single crisis. So the next time you hear about Federal Reserve interest rate decisions, remember where that power actually came from. It came from a forgotten panic, a failed copper scheme, and one banker's library on a quiet New York evening. If history like this fascinates you, subscribe. There's an entire forgotten era of financial history still waiting to be uncovered. Because the crashes we remember are rarely the ones that taught us the most. Thanks for watching.